Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be going over 5 stocks I am buying December 2018. So if you are brand new to the channel, I do make stock market, personal finance, real estate investment videos every single week, so consider subscribing. And let's go ahead and get into it. If you've been following my channel for any amount of time, you do know that I'm a dividend investor. I like to look for these value buying opportunities, and I believe I found 5 that I'm going to be adding to my wife's Roth IRA. These are all stocks that have been beat down. They're all trading at what I believe are fair value or undervalued positions. I see much more upside potential going into 2019 and beyond than downside potential. If you guys have any comments over any of them, let me know in the comment section below. If you have any opinions on any of them, also if you have any recommendations against them, let me know in the comment section below. And of course, if you do like the video, hit that thumbs up button below. And I just started my Instagram page down there at the bottom at financial_investor. Check it out. It'll be in the link below, and let's go ahead and get into it. So the first stock I'm looking to add to the Roth IRA is Cardinal Health, ticker symbol CAH. They've grown and paid out the dividend for the past 13 years. They're one of the largest drug and medical product distributors. They make 2/3 of their profits from pharmaceutical business. The other third comes from their medical business. Their closest competitor was ticker symbol MCK, which is McCormick, which had grown their dividend for 5 years. They actually showed a slightly higher position than this one. This one was more beat down, which is what I'm looking for. Those beat down stocks and that valued position. So their last price, $53.11, market cap $15.8 billion. 52-week range, their low is $48.14, so not a whole lot more to fall. Their high, $75.75. Now 1 year change, down 4.68%. Bottom left, over the past 4 quarters, they've missed 1 quarter, going 3 for 4, going into the 2019 second quarter. They're expected to decrease. This is all with interest rates rising. A lot of these companies are decreasing their earnings guidance going into 2019 and beyond, but we do see them picking up here in quarter 3. Morningstar has them currently at a buy at a fair value estimate of $82. Bottom right hand side corner, again, they're trading at $53.11. That puts them below their 200-day and 50-day moving average. The return on invested capital, 4.53%. Current yield on cost, 3.53%. Their current PE ratio right around that 10.66. Their price to book is at a 2.67, and their price to sales is at a 0.11. So as far as fair value goes, I believe Cardinal Health has a lot more upside potential than downside potential. Just within the US alone, they make around $100 billion in annual revenue. So one of those strong companies. I believe pharmaceuticals are going to be growing over the next few decades if they do any sort of healthcare, reform or expansion into medical coverage within the government. They're going to be having all sorts of products, and this is just a good sector to be in. So I'm trying to expand that portfolio a little bit more into the healthcare sector. Stock number 2, we have ticker symbol ED. This is the Consolidated Edison. They've been growing and paying out their dividend for the past 43 years. They provide electric, gas, steam services to 3.5 million customers over in New York. They have 2 competitive businesses, the Con Ed transmission and the clean energy business. Their closest competitor was ticker symbol PEG, which has just grown their dividend for about 6 years. They didn't really look as far, they were close because they were slightly under, but as far as competitors goes, Edison has that niche, growing and paying out that dividend 43 years. I believe they've been beat down in a really good position kind of moving forward. They're in that position to get their natural gas infrastructure. They're just in the electric, they're just able to provide that niche that New York needs as far as utilities and renewables. So we do see a lot more growth expected, about 3.5% annually over the next 5 years. So here, currently priced at $77.11, market cap $24 billion, 52-week low $71.12. So not a whole lot downside there if they do go down. Even if they go down even further, we have a crash. We may not see them hit $50, $40 range, somewhere within there. 52-week high $89.70. 1 year price change down nearly 11%. Now over the last 4 quarters, they beat expectations here, 4 for 4, going into 2019. Interest rates, a lot of companies out there are either lowering their guidance going into their last quarter of 2018 or first quarter 2019. This is just normal with rising rates. But we can see that this is a utility company. They're not going to be losing or gaining a whole lot. They're more of that, they kind of need to be their monopoly style. So utility company, you have to go to them if you're within that sector there in New York. Morningstar currently has them a hold fair value of $78. So I may not be picking this up right away, or I may add it to, it's already in my portfolio as far as stocks go. It's just not fully funded, but we'll see once it's added in there whether it'll move up or down. I'll just continue to average into it over the long term here. So currently priced at $77.11, below 50-day and 200-day moving average. Their current return on invested capital 4.76%, fairly valued there for utility. Their current return yield on cost, their current yield is at 3.71%. Current PE right around a 17, 18 PE, I believe is when I did my calculations. Price to book here 1.94. Price to sales in the red here is at a, price to book is actually 1.5, so that makes more sense there. This is more of an asset-based company, so their price to book would make more sense here at 1.5. Is fairly valued. So that is stock number 2. Stock number 3 is ticker symbol GIS. This is General Mills. They've been growing and paying out that dividend for 14 years, not 143 years. So they have been paying out a dividend for quite a long time. I know it's more than 20 years, but they have frozen their dividend during these tough times sometimes. So they've kind of grown their dividend over the last 14 years. So General Mills is one of the world's 9th largest producer and marketer of packaged goods, 5th just within the United States. They have 13 divisions competing across 20 different food categories. I misspelled competing there. They supply restaurants. Okay, I spelled that right. Bakeries, vending machines, and retail food distributors. Their closest competitor is Kellogg's, with 13 years of growing their dividend. So Kellogg's and General Mills, they share cereal, they share snacks, and they share competition there. Last price $43.31, market cap $25.8 billion, 52-week low at 41.01, 52-week high 60.69. 1 year price change down 19%. Over the last 4 quarters, they beat expectations 4 for 4. Going into 2019 second quarter, they're expected to meet their same 82 cents per share for their earnings estimate. Quarter 3, they're looking to project downwards, with rising rates again. I think a lot of these companies are going to be kind of going down slightly as they kind of get their feet wet, and then if the Fed doesn't decide to, raise rates, they're going to see earnings begin to come up just slightly higher, or earnings per share shouldn't be affected by the rates. Anyways, Morningstar has them at a buy at $58. So right near that 52-week high. So they're currently trading at $43.31. That puts them again below that 200-day and 50-day moving average. Return on invested capital is 12.02%, one of those higher ones. Their current dividend yield is at a 4.53%. Price PE ratio around 14.4. I believe when I did it, it was actually around 13 and some change. And the red, we have price to book at 4.1. This is a sales driven company. Lots of items out there. They just acquired Blue Buffalo, so this is more of that sales driven. So price of sales 1.59. Again, I believe this is fairly valued there as a sales driven company. So if you don't know, General Mills acquired Blue Buffalo just a few months ago. It's in that pet segment, so they're going to be creating some natural and organic foods, and pets need to eat all year long. So I believe this is going to be a good addition to what they're already offering their consumer products. So they're also going to be trying, if you look at General Mills, if you look at Kellogg's, they're both known for their cereal, their yogurt, their biscuits, all sorts of frozen meals. Between them both, you get a really good, diverse amount of products. So really good here, and I think that is it for General Mills. So let's go into stock number 4. We have Kellogg's, ticker symbol K. They have grown their dividend for the past 13 years. They're the global leader in breakfast cereal, cookies, crackers, and many other items. Now, when I want cereal, between Kellogg's and General Mills, I believe I go for Kellogg's. I think I have that strawberry oatmeal sitting in my cupboards that I have just about every day for breakfast. So 82% of their sales come from 3 areas in their business. U.S. cereal makes up 24%, retail snacks makes up 30%, and international cereal makes up 28%. So 24, 30, and some other change there. 60% of their sales come with just the U.S., but they're trying to diversify. They're trying to grow overseas in Europe and beyond, I believe in India as well. So I think this is really good for Kellogg's going into the future here. And I believe that their yogurt hasn't been as Yoplait, I believe, is Kellogg's brand. They haven't been doing really well there, but I have to see what percentage it actually makes up. It's a very small percent. Anyways, their closest competitor again, General Mills, which I'm acquiring anyways. So Kellogg's last price $61.89, market cap $21.5 billion, 52-week range 56.40 for their low, 74.98 for their high. They've gone down roughly 4% over the last year. Over the last 4 quarters, they beat 4 for 4, going into quarter 4 2018. They're expected to be slightly lower than their quarter 4 2017. Actually, going into quarter 4 and quarter 1 2019, they're actually lower estimates than their past quarters in 2018. This could be an overshoot, I believe, with the acquisition. No, this is Kellogg's. So they haven't acquired a whole lot recently, as far as what I know. I know they have Pringles and such. They're trying to distribute that a little bit more. But this one is just that solid base. I'm looking for some consumer goods. I'm looking for, that's why I'm adding these healthcare. I'm adding these utilities. I'm adding these consumer goods. I'm trying to create that base of these blue chip companies out there. And I believe that Kellogg's is just one of those that has been beat down recently. It needs that opportunity to just kind of rise and shine. So Morningstar does have them at a buy at a fair value of $81. Now, bottom right, they're currently trading at $61.89. Not their lowest for the year here. You can see 56.40 back in possibly May timeframe 2018. Now their high here has been recently here in September before that October crash. So I believe if I buy them now, I could see those highs in the 70, but I don't care much for the equity over the short term. I would like them to actually stay low so I can increase my equity in these positions over the next few years or months and such, and then get that nice dividend yield. So return on invested capital 16.16%, current dividend yield 3.52%, very nice starting yield. Price PE ratio 14.35, price to book 7.0, but again, sales driven company similar to General Mills, 1.59 for their price to sales, which I believe is fairly valued there. So overall, between General Mills and Kellogg's, I get a very nice consumer goods broad items. They have so many items out there, and that is going to go into my 5th stock, which is Triple M. This is the industrial sector. So Triple M, ticker symbol MMM, has been growing and paying out their dividends for the past 59 years. This is one I've been wanting to add to my portfolio for a while. I mentioned it to a couple other investors and a few other channels. I wish I had added it sooner, back when it was in that $180 range, but I just did not add it at that time. So Triple M, they're a diversified company. They have tons of products out there. If you go to any hardware store, just about any sort of has some sort of Triple M products. They own over 500 patents. Some of their items you can see in just about every store. Their Post-it notes, their Scotch products, their tape. They have ventilation masks over here in Oregon. All these California fires that we had during the summer, me and the wife and the kiddo, we had all these ventilation masks to kind of filter out the particles and the ash that was in the air. So Triple M is there. They're very technology driven. They have consumer items, safety, graphics, electronics and energy, healthcare, and industrial items. So very diverse company. Their closest competitors are ticker symbol ETN. Not a whole lot of knowledge in my head as far as what company. Then we have ticker symbol HON. This is Honeywell. I do have a few Honeywell products, but between these 3 companies, Triple M, ETN, and Han, I believe Triple M was one of the best, better ones with history of just kind of growing and paying out that dividend for the past 59 years. They're also trying to kind of expand here, and I do see them kind of moving more in that technology. There's a little bit of the bear sentiment, is that as technology begins to expand more in the world, a lot of their engineers and producers of, creators of these items are going to be looking for positions in all these, technology companies. But I believe that, those that want to work in this field, developing and creating products within the consumer, graphics, electronics, energy, will have a place here with Triple M. So 4 for 4 quarters, they missed 3 out of the 4. They missed 1 out of the 4, sorry there. So they passed 3 out of the And going into fourth quarter 2018, they're expected to rise there from 210 to 230. Very nice bump there. And again, a very nice rise between quarter 1 2018 and quarter 1 2019. Morningstar currently has them at a hold at a fair value estimate of $193. You can see they are trading at 198.69, which does put them below again 50-day and 200-day moving average. The return on invested capital is $17.92% and a current dividend yield of 2.74. Their price PE, price to earnings, is 19.96. I believe it's actually a little bit lower, around that 17 to 18. Their price to book is at a 11.29, and their price to sales is at a 3.67. So sales driven company. I would like to see this one fall back into that 180 range. I don't believe it will. You can see that when it did break its support level here back in the past, it broke below here, but quickly recovered and shot back up a little bit higher than $200 per share before kind of falling. So those are the 5 stocks. I believe that all 5 of these have a good value buying opportunity. They all pay out these very nice dividends. All of them have grown their dividends for the past 10 years. These are all stocks that have just been beat down over the last year. Some of them losing 15, 10, 20% of their equity just within the last year alone. So going into the future, I believe that these are staples, that are going to be, whether they do go down here over the short term, that allows me to average in, increase my yield on cost, decrease my unit cost, put more money into it. In 2019, our Roth IRA contribution limit is going to be increasing from $5,500 to $6,000. My wife's portfolio is the one that I'm funding right now. My own goal is mainly real estate. Both my properties are now fully done. We're going to get them on the market here and listed. I'm going to go checking them out this Saturday with my wife and kid, going walking through them, doing my inspections, and I should have a video covering that here very soon. So that is all for this video. If you guys did like the video, hit that thumbs up button below. If you have not checked out my website, my Facebook group, if you're not following me yet on Instagram, check it out at financial_investor. I will have links in the description below. And that is it. If you guys have any questions about any of the stocks that were covered, again, we had ticker symbol CAH, Cardinal Health, ticker symbol ED, Edison, ticker symbol GIS, General Mills, ticker symbol K, Kellogg's, and ticker symbol MMM. This is Triple M. So those were my 5 stocks. Do you agree with my 5 picks? Do you disagree with any of my 5 picks? Let me know in the comment section below. Would you not buy one? Would you buy one? Would you add something? Let me know. I like your opinions. I like hearing your guys' comments. I like reading your guys' comments and replying to your comments. So thank you all for tuning in. I will see you next time. Have a great day. Bye.